owner's discretionary. Uh, this is one of my only favorite strategies where you spend money. But these are things you're normally paying for yourself. So ODEs stands for owner's discretionary expenses. A lot of people refer to it as grateful expenses or perks. And when a client comes on, we do this first exercise called pre-tax your lifestyle. And we have a sheet, and it's a one-pager. I'm a big one-page person. And we go through this list, and we find that a lot of these are things that they're already spending money on. And now we just want to make sure they're deductible. So you see on here, you know, you got your vehicle, and I know this is small, but I'm going to read it to you. You got vehicles, you got meals, you got a cell phone, you got computers, you got home internet, you got home office. These are all things that you're going to want to take. Children on payroll, right? So here's some basics. These are like kind of my top six. Company vehicle, home office, home internet, office expense, and then cell phone. Cell phone I don't really have to bring up anymore. I assume everybody's writing that off. In the old days, there were some rules around it. Now it's just accepted right off your cell phone. And then make sure you're doing a home office. They created something called safe harbor rules, which I'll show you in a second. This is no longer the audit target it used to be. There's also a thing called an Augusta rule that says, hey, you can rent your property out for 14 days tax-free, and I'll talk to you about that. Shareholder meetings. A lot of you might have multiple entities. Well, the cool thing by law is you're supposed to do meetings, right? They're making you do it, so you get to deduct that. As long as it's in the U.S. or U.S. territories, deduction's pretty straightforward. It's more complicated if you go international. So if you go to Hawaii if you want, go to the U.S. Virgin Islands, not the British ones, right? There's lots of opportunities. Go to Puerto Rico. Those are U.S. territories, easy deduction. And then one final thing, if you got a business that's doing well, consider putting your spouse on payroll to double up your retirement deduction. And then kids on payroll can make a lot of sense for a few reasons. Since my kids were teenagers, I've been paying them whatever the IRA limit is. And so I'm making them do a little work because I'm kind of old fashioned. Some people start paying their kids at a pretty young age and say it's modeling. But I can tell you the IRS, if you're just paying your kids the IRA limit, which I think this year is $6,500, so far in IRS audits, they've been leaving it alone. Doesn't mean they won't change their tune someday, but I can tell you that's what they're doing now. And so what you're doing is you're getting deductible money pushed down to your kids. With my kids, this went into an account they were going to use for college spending, and then tuition we were putting away in a 529. And so it would go into a bank account. And then the second step is I would make a contribution to their Roth IRA. And I tell my kids, hey, you're not going to have a trust fund, but you're going to get out of college debt-free and no car payment, and you're going to have a sweet Roth IRA, right? So that's kind of what my wife and I came up with for our kids. So as you pay your kids, you're getting a deduction at your tax rate, and it's going to their tax rate, which is probably zero, right? If they're making less than 13K. And you're putting money in a Roth IRA, and I'm sure all of you guys have seen the charts that the earlier you start investing, the more decades it has to compound. And that's how, if you just do the math on average market returns, if you get 30 grand in a kid's Roth IRA by age 20, by retirement, it's over $1 million. So that's the reason to do that. Okay, home office. Again, not the IRS target it used to be, not the audit issue. They created something called a safe harbor deduction, which means if you use the safe harbor rules, they cannot and will not audit it. And so they give you a free $1,500 as long as you're using at least 300 square feet in your home for a home office. So just make sure you are. And the other cool thing is when you sell your home, you don't have to recognize a gain on your home office portion of the house, right? So no depreciation recapture. So they can't audit it. You don't have to substantiate it, and there's no depreciation recapture, and you don't have to worry about itemized deductions or anything like that. if you have two businesses that are run separately, maybe your spouse has one, there could be an opportunity for 2 home office deductions. So get with your CPA. All right, as long as it's different space, of course. All right, finally, the Augusta rule. This is separate from the home office deduction, and this says, hey, if you're allowed to rent your home tax-free for up to 14 days. And this means if you're doing, say, company retreats and maybe the Christmas party, your S Corp can write a check for the rental of your home, and you deduct it from your S Corp, but you don't have to pick it up as income as rental property. So this is a great way to do. Now, it's got to be a corp, can't be a single member LLC. And what you do to justify your rent is you either use the going rate, the fair market rate of hotel conference space in your area, or you use Airbnb listings. So it's an idea there. And so that's separate from home office deduction. So a lot of people will do like 5 days, right? 4 quarterly meetings and a Christmas party. Okay. And just remember, do a good job on these deductions. Be thorough. Just don't be greedy, right? Pigs get slaughtered.